So the last chapter we're going to look at is accounting for long-term liabilities. And as you notice, we're finally on the other side of the balance sheet because we're looking at liabilities. We're not going to ignore long-term assets, fixed assets, intangibles, and cost allocation, but that's something you're going to cover in intermediate two because of the way we split the coverage between courses. So now that we're in the world of liabilities, of course, you have to remember that things change a little bit. You're so used to debiting accounts to increase them. Well, now we're going to look at bonds payable in particular in this chapter. And a bond is debt, and it's going to be, of course, a credit to increase and a debit to decrease since it's a liability account. Now, what's probably going to throw you off a little more if you haven't been using intuition and just been memorizing things is that when we record a discount on bonds payable, since it's a contra account, now it's a contra liability account. And so we're going to increase discounts by debiting them and decrease them by crediting them. And then premiums, of course, since they are adjunct accounts, will affect liabilities with a credit balance because they're adjunct liability accounts now. So remember that because we're now on the debtor side of things rather than the investor, everything flips, right? We are looking at the exact same transaction we were from investing in debt, except now we're the ones who are borrowing money in issuing the promises rather than the investor who is giving the money and receiving the promises. So, of course, in general, liabilities are going to be probable future sacrifices of economic benefits. And so this means that at some point in the future, we need to sacrifice assets in order to meet some sort of an obligation that our company has agreed to. There are different types of long-term liabilities. In general, we have financing liabilities, operating liabilities, contingent liabilities. We are going to focus on financing liabilities in particular. With these lectures, you'll look at the other types of liabilities when you head into intermediate two. But like I said, there's lots of different types. Financing liabilities tend to be a rather large portion of the balance sheet for many firms. And so we give a little bit of special preference to them. They're also the ones that are most bound by time value of money, although some of these others are also time value of money conventions when we record them to value them on a balance sheet. So let's talk about bonds just in general for a while. You know, what's the theory or what the vernacular, the jargon, the different types of bonds there are. Obviously, these are just promises of repayment sold to creditors. They promise a lump sum amount, which is the principal, and then annuity interest payments in order to figure out the proceeds or the market price of the issue. What you look at is what is the present value of the principal, and then you add the present value of the interest payments. Your calculator will do that all in one step, but if you're going to use the table or the formulas, you have to actually determine two present values separately and then add them together to figure out what the market price of a bond is at any time. So the bonds can come in secured or unsecured varieties. Security means that there's some sort of collateral underlying the bond. So in the event of default, there are specific assets that can be claimed by the bondholder. Secured bonds will be paid first. They'll get the assets that they are entitled to. Then unsecured bonds, sometimes referred to as debentures, are not secured. They don't have an underlying collateral, and typically are going to be more risky because in the event of default, they don't have ties to specific assets. They have to take whatever is remaining afterward. So these types of debt typically carry a higher rate of interest because of that, because we have to be compensated for our risk. Subordinated debt is a lower tier that only receives claims after other specified parties. And so that's a sort of another stylized form of debt that can be present, and it just represents a very low rung of debt holding. Right? So if we think about the bond indenture, this is the actual bond contract on which the terms are stated. It includes, of course, a maturity date, when the lump sum is going to be due, the stated interest and the interest payment dates. You always got to be careful. When was the bond issued? When is it going to pay its first interest? Because that can affect the bond accounting, as we've seen in our investments talks. Conversion privileges. It can be sometimes convertible into common stock, and covenants are very important on debt. Typically, they set limits on how much new debt a firm can issue, the dividend policy of the firm. They can set minimums on ratios. For example, your current asset ratio can't dip below 1, or you have to have sales growth of X%, things like that. More so related to what the mix of your assets and liabilities or your debt and equity is than profitability ratios. Typically, in general, bonds are sold in $1,000 increments. So, when I say $1 million bond issue or $10 million bond issue, that typically doesn't mean that one person bought all $10 million of the debt. It's that we issued $1,000 bonds to various investors that bought a varying proportion of the amount of principal. So each individual bond would have 1,000, which means in an issue of the 1 million, we would have had sold 1,000 $1,000 bonds, and they will typically pay interest semi-annually. Although I will use a lot of annual interest examples and problems, simply because semi-annual interest takes a lot of math, a lot of time-consuming math to get through just 1 year. Most bonds are going to be registered bonds. Registered bonds have a system where the check is just mailed directly to the owner of the bond or transferred via electronic deposit. It used to be the case that bonds were what were called coupon bonds or bearer bonds. If you're a fan of old Die Hard movies or something like that, you would see a scene where they talk about bearer bonds, and it is kind of dated. But this is where bonds had coupons actually printed on the indenture, and then you clipped them off and mailed them in order to receive your payment. Again, that doesn't happen quite so much anymore. We have automatic payments that go through registered bonds. And then a final feature of bonds that you should be aware of are callable provisions. A call on a bond is an option where the firm can retire the bond prior to the maturity date at a specified call provision value. So if it said that the bonds are callable at 102, that typically means 102% of the face value of the issue. And of course, they don't have to call all the debt unless it's mandatorily callable, but they can call, say, 60% of the bonds on a certain date. And that callability provision may kind of mess with how we set the maturity date of these bonds. So sometimes the callable provision is used as N, the terminal date of the bond, when we think that the bond issuer is actually going to recall the bond rather than the maturity date, right? It's sort of a preemptive or premature maturity date. And so, certain situations can arise there, and we'll talk a little bit more about them as we get into it. When it comes to the bond issuance, very similar, like I said before, very similar to what we're doing with notes receivable, to what we're doing with investments and debt. Both the stated and the market rates are going to lock in on the date of issuance. So whatever those are, they sort of become our historical market and stated rates, if you will. And for accounting purposes. So we ignore the real world, because in the real world, the market rate is going to change daily after the bond's been issued. The yield is always moving on bonds, which affects the bond market. And while they don't affect the accounting for the bond on the company's books, they do change the fair value of the bond, not the book value of the bond. Remember, the book value of the bond is related to the accounting that we use in order to determine what is its amortized value. Whereas the fair value of the bond is market-based. It's based on what the bonds are trading at, and the risk of the firm, how that's been shifting over time. So those are two ideas that you kind of need to start to separate in your mind. Again, that fair value is not always reported on the balance sheet, and we don't report the fair value of our liabilities. As the issuer, we don't record these fair value changes. Now remember, as a debt investor, we did. We had to classify them as trading or available for sale or held to maturity. But as the as the issuer or the person who is going into debt and financing with a bond, we don't make this classification choice. The only thing that the company could do is what they call opt into the fair value method. But once they do that, you can't opt out. You can't switch from fair value method to amortization of the effective interest rate. You either have to stick with the fair value method or just go with the normal accounting for time value of money instruments. Anyway, so by and large, companies do not opt into that fair value method because it creates a lot of volatility with their liabilities, and they will stick with the amortization of a discount or premium using the effective interest rate method that we have used all along. Okay. Another special thing about bonds at issue is that a lot of times we'll hire an underwriter. An underwriter is someone who will help us place the bonds to help us sell them. And in fact, they typically guarantee a certain return, and they then assume the risk of providing the firm with the return that they said they would get. So for example, they'll say, we'll issue these at 102. Which means 102% of the face value, then the underwriter would have to sell them at that, or they would have to make up any loss to the person that they agreed to sell the bonds for. Underwriting is typically how a lot of bond placements go. There can be some private placements where there is a direct, sold directly to a large institutional investor, maybe just directly to a brokerage, not as an underwriter or a middleman, but as a last stop. And then the brokerage will sell them on at a later date. A bank, we could even, issue them to other institutional investors like mutual funds, pension funds, those sort of big, large financial institutions. So when we talk about bond valuation, there's a couple of things that we need to secure in, again, our wheelhouse, kind of get our vocabulary on the same page. Of course, a bond is going to be valued at the present value of its principal and interest payments. So this is the same thing we've been seeing all along. This is its carrying value, which is equal to its face value minus a discount or plus a premium. And so this is, again, going to use that historical market rate at the bond's issue. All right. So we're going to take all of that, discount it at a rate appropriate to the bond's risk class. A rate appropriate to the bond's risk class is another way of saying the market rate. Because markets are typically efficient in that they impound all of the information about a firm and then set the price equal to an appropriate discount rate that's discounted for the risk of the firm. And it has to be over the specified time to maturity, which is our N. So we have the same pieces of future value play, or future and present value played in here. Other names or other ways to describe this process of issue is, like I said, the rate appropriate to the bond's risk class. It can also be referred to as the effective rate of interest. It's the effective rate of interest because that's effectively the rate that is being earned. The market rate, sometimes it's also called the yield at issuance. And so you should know all those names as synonyms for a market rate. So you might see the bonds were priced to yield 10%. Bonds to this issuer's risk class typically trade for 8%. So those are both market rates. Another form you might see is, rather than stating the market rate, they might tell you what the bond sold at. So if you see two bonds sold, one for 98 and the other for 103, what that would indicate is a market